Hi, I'm April, here with your tax fact. So what happens if you can't sell your home and you've moved into a new one? A lot of people these days will simply rent out their old home without really thinking about the tax consequences. There are also a group of you that buy real estate and rent it out as an investment. I'm going to go through a couple things to take care of how you're going to file the rents on your income tax. So let's get started. You'll want to be sure to keep track of the rental income and expenses that you spent for the year. I would recommend that you either use Excel or just simply a book that you can jot everything down in one place. It's really easy. So you want to keep track of the rents that you receive, making sure to know any security deposits that you may have gotten. Now, security deposits aren't taxable because you're going to return them to the tenant, unless of course they broke something, but you're not going to need to worry about that on your taxes. The expenses to keep track of normally would include things like advertising, lawn care, snow removal, management fees or commissions paid to a realtor, mortgage interest, homeowners insurance, real estate taxes, and any utilities that you pay, not the tenants, like water and sewer. And also you can deduct mileage for trips back and forth to the property. One of the things you can deduct is maintenance and repairs, but you have to depreciate improvements. So how to spot the difference? If the improvement increases the value of the property, it must be depreciated, which means written off over several years. If it's a repair, you usually are just replacing something that's broken, like a switch plate cover or a doorknob. You also get to deduct the cost of the property, less the land value. You can look at your original settlement sheet and find how much you paid for the house. Plus, you'll want to add any improvements that you made whilst you were living in the house, if that's the case. Both the building and the improvements will be depreciated, which again just means that you're going to spread the cost over several years, which in this case is generally 27 years. If you're just renting your former home temporarily until you sell it, you're sitting on a profit when you sell the home, then follow this advice, because what you want to do is maintain the home's primary home tax status and get the lower taxes. So first thing you want to do is don't deduct any losses from the operation of the property. You'll still need to report it though, but there's a special area on your return where you can do this. Also, you must have lived in the home for at least 2 of 5 years as your primary home, and you must sell it within 3 years since you moved out of the house. If the property is located within the city of Philadelphia, you'll also need to get a business privilege license and pay business taxes on the rental property income. So if you need any help getting everything together, there's a rental worksheet available at our website, which you can download, and hopefully this has been helpful. I'm April, and this has been your friendly tax fact brought to you by Ambrozy Accounting.